Hi team, this is Ritu and I'm here to present Power BI project on credit risk analysis. We will discuss in this project default patterns, default rates, loan to income ratio, risk score, loan risk factors and strategic recommendations. If we have look on our data set, so this is the data set and this table consists of multiple columns. As we can see, we have home person, ownership, person, employment length, loan intent, loan grade, loan amount, and so on. Okay, so to play the animation, we need a little scroll up here, just like this, and click on this slide and hover the cursor, the blue background color. You can see there's a blue color in the background of this slide. As I hover this cursor on it, so now I'm getting a play button in the bottom of the slide. Like this. Okay, now I can move cursor here and like this. After clicking outside, we have to again hover the cursor here and I have the play button. So this is the animation of this slide. Now let's begin the visualization. So here we have the questions of our project and this is the visualization of our question. Let's explain the average loan amount, default rate and default rate by loan grade chart. So this is the objective slide. Okay, so the loan grade A to G shows a strong upward trend. As you can see here, from A to G, there is an upward trend, both average loan amount and interest rate as risk increases. Grade G borrowers take the highest average loan amount and face the highest interest rate, indicating maximum perceived risk. Default rate rises sharply from 10% to 98%, which is A to G, showing a clear relationship between loan grade and borrower risk. So overall, the bar chart shows the lower grades A to C have low default rates, while higher risk grades as E to G show major jumps. Okay, moving forward with the another chart is scatter plot. Mm. It depicts that average interest rate and default rate by loan grade. So this scatter plot confirm a positive correlation between interest rate and default rate. As interest rate increases, the default rate also increases. If we see grade D onwards, both default rate and interest rate accelerate, indicating lenders increases pricing as risk grows. Grades F and G from the highest risk cluster and with the extreme default rate and the highest interest cost. Overall, the long grade is a strong predictive indicator of both repayment behavior and pricing. And this is the combined chart of the default rate, loan grade, average loan amount, and average interest rate. As default rate rises sharply from grade A to G with 10% to 98%, showing higher grade loans are far riskier. Average loan amount increases with lower credit grades, meaning riskier borrowers receive larger loans. Interest rate also rises from A to G, which is 7% to 20%, reflecting higher risk pricing. So overall, loan grade strongly predict risk is worse grades is equal to higher loan amount, higher interest rate, and much higher defaults. Moving on the next question. Now we have the pie chart of loan status by employment length. So the borrower with the 0 to 3 years of employment contribution, the highest share of total loan records, indicating many applicants are early in their careers. If we see the employment length around 7 to 10 years, also from a large portion showing strong representation from mid-career borrowers as well. And if we see 15 plus years, meaning fewer applicants come from long tenure groups. If we see clearly in this chart, from 15 plus employment length, as you can see there are fewer long-term tenure. Okay, the next chart is loan status by home ownership. In this you can see the 0 loan status represent non-default rate and 1 is default rate. Default is where the borrower did not pay the loan. 1 is where the borrower paid their loan, and 0 is borrower did not pay their loan. So when we see in the rent category, so in default rate we have where loan status is 0, which means default rate is 0. The count of person employment length is 11,000 F here. So it's interpreted that enter show the highest number of default, which means borrower who rent have the largest count in loan status, indicating that renters are more financially vulnerable compared to those who own or have mortgages. And homeowners, which is on, so have very low default count. Borrowers who own their homes outright show have low default, making them the lowest risk group based on the homeownership status. And if we see in other category, so there is also a very low, uh, very low default rate and non-default rate. Here we have again combined view of person of ownership, count of person, employment length, and default rate. So renters have a high default rate, which 32% suggesting higher credit risk. The other category, those small in count, show a high default rate, which is 31%, and may represent a riskier segment. The next question is average income, loan income ratio, average of loan amount, and loan to income ratio by loan intent. We will continue with this chart, and this chart, and we see the home improvement data. So here we have the loan and intent is home improvement, and average income is 73,000 around, where the loan amount is 10,000, and the loan to income ratio is 13%. So it indicates that very low risk and strong repayment capacity. So the first question arises, what is loan to income ratio? The loan to income ratio is where borrower loan amount is 13% of their yearly income. So it means it lies in safe line, and as we see in this ratio range, if from 0 to 20%, it represents that very low risk and with strong repayment capacity. So that's why there is very low risk. And if we see loan intent of medical, so there is a slightly higher than the home improvement of personal and debt consolidation, venture, education. So this is slightly higher in the medical, but it is also lying a safe line because it is less than 20% of interest rate of reassurance. Sorry, so that's why it's also in a line safe line. So it's also interpreted that very low risk, strong repayment capacity. And here we have the combined chart of loan intent and loan to income ratio, which we can see clearly in this chart. Now let's moving to the next question. of visualization, which is default rate by credit personal uh, person credit history length. Let me check. Okay. Okay. So in this chart, as we see, the short credit history from 0 to 2 years often correlate with higher default rate due to limited financial track record, and longer history, which is 10 plus years, may show lower risk, indicating more stable borrowers. As we can see, they have a long history. That's why. Let's have a look on it. Explanation. So default rate are highest at 0 years of credit history, which is 24%, indicating increased risk among individuals with no prior credit record. Between 15 to 17 years of credit history, default rate declined to 0.22 and 0.19, showing comparatively stronger repayment pattern in this range. At 21 years of credit history, if we see here, at 21 years of credit history, default rate rises to 30%, breaking the earlier decreasing trend. As we see here, 19 and 22%, it is breaking the earlier trend with 30%. So from 25 to 27, default rate increases further to 28, 33, 43%, reflecting greater variability in this segment. So the relationship between credit history length and default rate is non-linear, as we can see this clearly, with noticeable fluctuation across different ranges, and the highest fluctuation between 23 to 28 30 history length. Borrower with 15 to 17 years of credit history show the lowest default rate in the provided data, and longer credit histories 25 plus years display higher default rate with the data set. Now we are on next question, and this visualization depicts simulated default rate by interest rate parameter. So let's explore this chart. As we can see, we have interest rate parameter. So this formula calculates how many borrower default when the interest rate is at or above the value we choose in the what if parameter. So if I choose 8%, let me choose precise number, not with, okay, not precise, okay, 7%. So I chose 7%. So this shows if interest rate rise to 7% or more, how many default will be here. So as I have applied filter from 7% to 25%, if we see here 7%, we have approx 24,000 people which they have default rate, means they are not able to repay their loan, or stop paying altogether. So as the interest rate decreasing, if you see, sorry, as the interest rate increasing, the default rate as in, let me see clearly. Okay, so as the interest rate decreasing, so default rate is also, no, no, let me, okay, I'm sorry. So we see as the default, as the interest rate increases, like 10, then 11% and 12%, so the default rate is decreases. So default rate decreases, and as interest rate increases. Let's have a look at the interpretation. If we see as the interest rate parameter increases, the default rate count drops consistently across the entire range. The highest simulated default occur at lower interest rate values. So after 15%, we see after 15% here, the default count falls sharply to below 5k, eventually approaching zero as the rate parameter reaches 20% and above. So the curves show a smooth downward, indicating a strong inverse relationship between the interest rate threshold and the number of loan meeting or exceeding the rate. So the lower interest rate threshold include most loans introducing the highest default count in the simulation. Overall, the measure reflect how many loans have interest rate greater than or equal to the selected parameter, as I have selected before 7% to 25%. So not actually default probability behavior. So that's how we predict the default. So next question is the risk score. And it will tell if we see, sorry, if we see risk score. Now we are on the page of risk score visualization. So it will tell how the borrower is riskier. So the risk score predict default probability, loan approval decision, and compare borrowers. If we see the chart here, build credit models, identify high risk segment. Okay, so let's continue with the interpretation of the risk score chart. Risk scores across all loan intent are very close, indicating minimal elevation in borrower risk profile by purpose. ABC home improvement loan show the highest average risk, which is 6%, suggesting slightly higher perceived borrower risk in this category. Debt consolidation, so it is 6.55 and education is 6.53, fall in the mid range, showing balanced and moderate risk. Overall range is very narrow, indicating that loan intent does not strongly influence the model risk score, because as we know the from 0 to 20% is represent very low risk and strong repayment capacity, as we discussed previous visualizations. And in this combined chart, the borrower with higher risk above 9 often show a credit bureau default flag as yes, as you can see Y, indicating a strong link between past default and elevated risk. Individuals with lower incomes tend to have higher risk scores, suggesting income plays an important role in risk assessment. So the most loans have relatively small first loan to income ratio, meaning loan amount are proportionate to income for many borrowers. So the overall average risk score is around 6.53, indicating a moderate risk level across the entire borrower sample, which means they approve the loan and we can easily decide the loan amount and decide the interest rate as well. Risk score here gives a quick data backed idea of how likely someone will default or not. Okay, now let's move on to our dashboard. So here we have our dashboard with the all previous visualization as we discussed. And if I go to risk assessment, so these are the visualization of risk assessment with the default rate by loan intent, simulated default rate by interest parameter, and average income loan to income ratio, and average loan amount by loan intent. So here we have the overall of loan default rate, which is 22%, and loan income ratio is 15, and average risk score is 6.53, which is very low risk or moderate, which means a strong repayment capacity. And we see here average of loan amount is around 10,000 with the interest rate is 11%. So here we see the interpretation of dashboards. So here we have the interpretation of dashboard, and the dashboard highlights overall borrower risk level and repayment behavior across different segments. And, and the loan characteristics such as loan intent, grade, and credit history length reveal clear pattern in risk and borrowing habits. With the employment length and ownership filter help identify distinct borrower group which with varying likelihood of default. And if I go to risk assessment, so overall the dashboard provides a clear view of risk trend, enabling quick identification of safe borrower segments and high risk categories. So now I conclude my presentation. Thank you for your time and attention.